Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Happy New Year, everyone. I hope everybody had a restful holiday season because markets are off to the races this past week, with rates immediately moving higher in most of Europe, the US, and the UK. To me, this says investors do have a general outlook for higher rates this year. They may not have wanted or have been told to not take a lot of risk into the end of the year. Whether that plays out remains to be seen for the rest of this year because we're only through the first week and January can often be quite a volatile period. But I thought it would actually be helpful this week to spend a few minutes recapping our main views, which is for higher rates in all those jurisdictions and generally stronger dollar, but also stronger sterling versus euro and Swiss and the central banks that aren't going to be necessarily on the move. We also look for a tough period in EM. And as we've been talking about really kind of in through mid-November into December, that this monetary policy transition period would be a choppy period for risk assets. Now, that choppy period for risk assets is certainly starting to come true this first week, and it's exacerbated by the talk around Fed reducing its balance sheet, or what we're going to call going forward quantitative tightening, QT, which has been a significant source of volatility for both rates and equities already this year. Now, as we head into the first quarter, I'm going to bring in Brian Daingerfield, our co-head of G10FX strategy, to give us a read on what he thinks the major themes for the first quarter will be. So let's go right there. Hi, Brian. Thanks for joining us. Let's start with that very important central bank theme. I mean, it's going to be with us all year, but especially as we head into the year. What's the overall outlook? What's the monetary policy landscape? Review what we see from a high level, and in particular, given this past week, the Fed and quantitative tightening.
Great. Well, thank you very much, John, for having me. The 30,000-foot view of the economy right now is we have a recovery that's ongoing, albeit fragile and unsynchronized. And we have an inflation outlook that's uncomfortably high for a lot of central banks. And so central banks are in sort of a difficult position. You have inflation that for a lot of reasons is high because of reasons that central banks can't really control, shortages being really the main culprit there. And it's uncertain as to when those shortages could alleviate and inflation could ultimately start to come down. But you have a recovery that's, as I mentioned, ongoing, and inflation being high to a point where central banks are sort of being forced into this difficult position of moving forward perhaps faster than they would have liked in terms of tightening. We certainly saw that across emerging markets where inflation was running quite high, and you saw some tightening cycles really begin in 2020. In 2021, I should say. In 2022 now, we have the same discussion really accelerating with developed markets as well. So you've had some tightening starting in Antipodeans in New Zealand. You have you had a rate hike by the Bank of England in December. But as you mentioned, the Fed is really the focal point of this discussion in January because of the minutes that we just got for December. What really struck us as surprising is Powell did allude in his December press conference that they discussed balance sheet rundown at the December meeting. But when you look at the minutes, over 1,400 words were dedicated specifically to this topic. Now, the Fed is still in the process of buying assets. They're still doing quantitative easing. And at their current pace, they're scheduled to complete that quantitative easing in March. So we're still 3 months out from the end of quantitative easing, and we've already had a very full preliminary discussion of what the next stage of the balance sheet might look like. When does the reinvestment phase begin? When does that reinvestment phase end? As in, when does the stability of the balance sheet end? And ultimately, the balance sheet begins to run down. So certainly the Fed has started the year off with a bit of a hawkish surprise. Now, is it surprising that they talked about it at all? I don't think so, because Powell already alluded to that. What was really surprising to us was just how much detail the Fed was willing to give at this stage, especially because they're still buying the assets that they're already talking about running down. So that speaks to that discomfort with inflation. That's not just a US phenomenon, that's really a global phenomenon.
All right, well, what about the virus? What about Omicron? How does this enter our mix?
So Omicron variant certainly introduces uncertainty into a number of avenues, but really one of the biggest things, in my mind, is we have a recovery that's fragile and discordant. Omicron adds to that risk, and we have inflation that remains high. And while we may still believe it's transitory and that inflation rates are set to come down, that variant risk can delay the time it takes for that inflation to come down, simply because it could elongate the shortages that we have been feeling, whether it be in the labor market or be in supply chains. And so from that perspective, I think Omicron risk really kind of adds to a lot of the themes that we've been talking about rather than taking away. And I mean, I think we've all been pretty shocked by the case growth that we've seen, certainly here in the US, but really across the world. I think it's fair to say that the early evidence has perhaps been encouraging about the surge in cases not being as closely linked to surges in hospitalizations and mortality. That's good news. From an economic perspective, you still had pretty strong retail sales in the US, and the latest reading that we had gotten, I think that's fair to say that that's good news as well. And so from a growth and demand perspective, I think we're still hoping for the best, that the Omicron variant, similar to Delta, is not going to lead to a significant retrenchment in consumer demand. But at the same time, Omicron could delay the timing at which we get back to a quote unquote normal state for inflation. So that again leaves central banks in a very uncomfortable position where inflation is too high. We're expecting it to come down, but we don't know how long that will take. Omicron simply adds to the risk that these shortages last for longer and that process of normalization takes longer. And as a result, we're being sort of pushed in the direction, squeezed in the direction of more hawkish rhetoric and more hawkish decisions really across the G10.
Yeah, I mean, that is pretty interesting, right? I mean, you have a new virus development that actually is a hawkish development, especially, again, I'll just throw in that, it certainly seems like governments are not in the mode of adding restrictions or locking down, and we're learning to live with this. It's not as fatal, as you referenced. But at the same time, if people get sick, the good production chains, and especially with zero COVID policy in China and in the East, it's like it doesn't hit demand, but hits inflation. So, again, we need to change our mentality a little bit, where normally it's like, oh, virus developments, that's bad, central banks might pause, but it actually feeds into this loop that we've had, which has actually caused a lot of this inflation, at least for this variant. And let's hope we don't go back to the old way for sure. So one last question, Brian. What about energy and commodities? I mean, 2021 saw a year of squeezes and shortages. What do we have in store for let's just say the next month or so? I'm not going to ask you to forecast the year's worth of, price movements in oil and other commodities, but, what's your sense just for the next month or two, let's just say?
Well, we're in a period now where, taking a look at oil prices, for example, where the onset of the Omicron variants really in the end of November, early December, led to a pretty sharp fall. That in concert with a release of the Strategic Petroleum Reserve by the US and 5 other nations, including China, and then a surprise OPEC decision to not respond to that release of barrels from the US and others by reducing its own production. Instead, OPEC has really stayed the course. So that combination of factors in late November, early December pushed oil prices down pretty dramatically over the course of a couple of weeks. Really, since then, we've rebounded much of that decline. And I think there's a couple of things really at play here. One is you do have outages. You do have temporary supply outages coming from a couple of nations, Libya and Nigeria, and among others. Certainly more recently, there's been unrest in Kazakhstan that's probably having some impacts, some positive impact on oil, simply because as unrest leads to the possibility that supply could be disrupted, and then that leads to potential positive for oil. But at the same time, as we discussed, it's not obvious that you've seen a huge retrenchment in consumer demand, despite the fact that you've seen a surge in Omicron cases. And that, I think, is also part of this process, that as oil prices fell dramatically in late 2021, there was an expectation that, we would see maybe a greater decline in oil demand as we saw a real retrenchment in travel, and commuting, for example, commuting to work as we return to a work from home environment. But instead, I think demand has remained fairly resilient in the face of this. And so you have oil prices that have recovered quite a bit of that move. I think the overarching picture is one where demand is likely to remain quite solid, and supply has been slow and is going to continue to remain slow to catch up with that demand. And so I think the risk reward remains to the top side for energy prices. Certainly, we're at a period now. We're in January. It's quite cold in the northern hemisphere. That likely means you're going to continue to see strong demand for natural gas as well. To the extent that there could be any switching from expensive natural gas into oil, that probably is a positive influence as well. And so I think we have a positive overall conditions for commodity prices. Certainly the risk would be if Omicron turned out to be worse. But as I mentioned, I think the early readings that we've had have been encouraging, even if the case growth really has certainly been discouraging.
Yeah. So again, tying it back a little bit to the same theme, not a lot of relief for headline inflation if we continue to see, commodity prices, especially energy prices, stay buoyant. All right. Well, thanks, Brian. That was a lot for the first week. It still feels like we barely scratched the surface, but we'll be getting deeper over the next few weeks. As usual, for the first podcast of the month, we're recording this before the U.S. non-farm payroll report, which we didn't even really get to. We'll talk about that next week. But as well as we also are getting the European CPI reports, and obviously with inflation so critical, that's going to be something we touch on. Next week, we're actually on watch for U.S. CPI, again, feeding into this whole conversation, as well as U.S. retail sales. And then in the UK, we got industrial data and GDP. So, the year's got a lot to chew on in addition to just the general monetary policy moves we're seeing. So with that, I'll just say welcome back, everyone, and all the best for 2022. Talk to you next week. Thank you. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.